So now let's see what happens when you introduce a risk-free asset into the mix. Now we've talked about the risk-free asset some already. Remember, it's obviously, as it says on the tin, an asset that has no risk of default. It's useful to think about what that actually might mean in real terms, both in terms of practice and also in terms of inflation. So in terms of real as in net of inflation, it means the price should actually be indexed to inflation, because even on a default-free, technically risk-free bond, you could actually end up making a loss if the inflation rate rises dramatically, right? And furthermore, since we know now the difference from our fixed income lecture between a holding period return and yield to maturity, we should actually expect this asset to have a maturity equal to our holding period, so that we don't have any undue uncertainty introduced by holding period that is different from the maturity of the asset. Now, with those preliminaries aside, generally when we talk about a risk-free asset, we'll talk about US government securities, T-bills, but you could also think about maybe other government securities, or, as for a little while, people were advancing things like maybe the least risky tranche of a mortgage-backed security as really, really low risk. But then, of course, we found out how that actually turned out in the financial crisis. So sort of the classic risk-free asset is still the US government T-bill, and that's really what we'll talk about in these lectures. Now, theoretically, the risk-free asset should have a variance of 0, because, as we saw with those payoff trees, for example, no matter what state of the world arises, you still get the same yield to maturity or same holding period return on your risk-free asset, assuming you hold it to maturity. But in practice, as we saw with the historical record of US T-bills, there is still some variation in prices. And the other thing that theory suggests is that, of course, it would have a covariance of 0 with risky assets. And that may not necessarily be true, and a lot of this sort of deviation from theory is introduced by the idea of inflation. T-bills, unless we're talking about TIPS, the Treasury inflated protection, or inflation-protected securities from our discussion about financial assets in the very beginning of this series. Those are protected from inflation, but the others are not. And of course, inflation does also determine or affect the prices of other assets, so non-indexed to inflation, that is, risk-free assets might actually have some covariance with other risk-free assets. But if we assume that our risk-free asset is inflation indexed, then these theoretical assumptions are quite reasonable. So now how do we think about capital allocation between a portfolio of risky and risk-free assets? Well, let's start simply, and let's say that we've already done the hard part and we've already created the portfolio of risky assets. And now we can also then allocate some of our wealth to that portfolio of risky assets we've put together, and the rest to the risk-free asset. So in other words, our capital allocation decision is going to be just how to divide up our total wealth between these two portfolios now. The risky portfolio we already have assumed we've put together, and the risk-free asset that we are now introducing. You can think of it as sort of a recursive solution. We assume we've done the hard part, now we're going to do this step, but later we'll actually go back and show you how to optimally construct the risky portfolio as well. So let's look at it this way. Let's say that we have a total market value of our portfolio of 300,000. Let's say that the money market, the risk-free component, has a market value of 90,000. And the risky stuff is a portfolio made up of equities of 113,000 and bonds of 96,600. And all told, those add up to 210,000. And plus our risk-free allocation, that adds up to our total market value of our portfolio of 300,000. So what are the weights that we have implicitly picked? Well, as far as our risky portfolio, equity comprises a weight of 54%, right? Equity is worth 113,400. Our total risky portfolio is 210,000. Our bonds are the remaining 46%. Remember, we could either take the value of bonds over the total portfolio, or we could just take 1 minus our equity, since our portfolio of risky assets is just made up of equities and bonds. So if equities are 54%, bonds must be 1 minus that, or 46%. So now let's introduce an additional weight, which is to say the weight that we will place on the risky portfolio as far as our total portfolio. And then 1 minus W will be the weight of the risk-free assets. So what is the weight on the risky portfolio in our complete portfolio? Well, remember, the complete portfolio was worth 300,000, we said. The risky assets are worth 210. Therefore, the weight on risky assets is just the proportion, or 70%. And that means that the remainder is in the risk-free asset, or 1 minus 70%, or 30%. So now we can actually calculate the weights of all of the assets relative to the total portfolio. So for example, the weight of equity in the total portfolio, including the risk-free asset, is 37.8%. The weight of debt in the, well, I should say risky long-term debt, in the total portfolio is 32.2%. And then, of course, the remainder is in the risk-free asset. So now let's characterize the return and risk of this portfolio. We can do this as we did with the portfolio of risky assets. We're going to first calculate the expected return to this portfolio. We're going to look at what the expected return to the risky portfolio is, denoting that with P. We're going to denote the expected return to the risk-free asset with our F. And we'll make a reasonably strong assumption that we can actually also borrow at the risk-free rate. This one is not a terribly likely assumption, right? Because very few of us can borrow at the same rate as, let's say, the US government. But we'll see how to adjust for that later on. For now, let's just take that as sort of a price of admission. Now, let's say that we want the return on the complete portfolio and the volatility of the complete portfolio. We're going to denote the complete portfolio combining both the risky and risk-free assets as C. And we'll say that we'll assign a certain amount of our portfolio Y to the risky portfolio and the remainder to the risk-free asset. Now, the expected return to the complete portfolio, using that same intuition that we developed for the portfolio of risky assets, is just going to be the weight times the expected return for both of the assets in this portfolio. So the weight on the risky portfolio is Y, the expected return on the risky portfolio is this expectation of our P, and we already know how to develop that based on our discussion of portfolios of risky assets. The weight on the risk-free asset is then 1 minus Y, And we don't even need to take the expectation of the risk-free rate because, well, being risk-free, it's already set and not changing, so it's just whatever the risk-free rate is. Now, we can simplify this mathematical expression a bit by distributing RF into 1 minus y, and then collecting terms in y. So we've got 1 times RF here out front, and y times the expected return on our risky portfolio minus RF. This is nice intuitively because essentially it says that the expected return to our combined portfolio is the risk-free rate on everything plus however much we've assigned to the risky assets times the risk premium on those assets. What about the standard deviation of this complete portfolio? Well, we're going to claim that it's going to be linear in the standard deviation of the risky portfolio. In other words, however much the risky portfolio is, however high its standard deviation is, we're just going to multiply that by the weight that we've assigned to it, and that'll be the weight of our complete portfolio. But let's actually unpack that. Why would we expect that to be the case? Well, here's where remembering this formula for the variance of a 2-asset portfolio really is so useful in building intuition about portfolio theory. Let's bring it back. We've got this formula here. And let's think about the 2 assets actually being the risky asset and the risk-free asset. Now let's simplify this formula substantially, right? Because the risk-free asset has a variance of 0. So let's call asset 2 the risk-free asset. That means that this term is actually going to go away because this goes to 0. And actually, remember, if we make this assumption that our risk-free asset is indexed to inflation, has 0 covariance with all risky assets, this term also goes to 0. Because if the covariance between the risk-free asset and any other asset is 0, well, it's 0 between that and our risky asset. So really all we are left with is the weight on the risky asset squared times the variance of the risky asset. Well, what was our weight on the risky asset? That was y, so we're going to take y squared. The variance of the risky portfolio is sigma p squared, and therefore if we want to solve for the standard deviation of the complete portfolio, well, we now already know its variance. To get the standard deviation, we just take the square root, and that gets us y times sigma p. So this is how, by remembering the formula for the variance of a portfolio of 2 assets, we can actually very easily prove what the variance of a portfolio containing a risk-free asset and a risky asset is. Now, let's go back to our expected return formula. Remember, it's the risk-free rate on everything plus our weight on the risky portfolio times its risk premium. And let's do a clever transformation. Let's actually substitute in what we now know about the relation between the weight on the risky asset, y, and the standard deviation of the complete portfolio and the risky portfolio. We know that the standard deviation of the complete portfolio is just the weight on the risky asset times the standard deviation of the risky portfolio. So let's solve for y as the ratio of those and substitute that in for y right here, which gives us this updated version of the expected return. And then with just a bit of rearranging, we can get this version of the same expression. And now what we're saying is that the expected return on our total portfolio is still the risk-free rate times the volatility of our complete portfolio, sorry, the risk rate plus the volatility of the complete portfolio times a quantity that we're going to call the Sharpe ratio, the risk premium on the risky portfolio divided by its standard deviation. This is a ratio we're going to see a lot of, and it's really important to portfolio theory as sort of a measure of the attractiveness of a risky portfolio. You can think of it as sort of the compensation that you get for bearing risk. And so essentially what this expression is now saying then is, tell me how much risk you want to take in your complete portfolio. For each unit of risk you take, you will get a certain amount of risk premium, and that will determine your expected return. So you can also think of the Sharpe ratio as sort of like a price of risk. For each additional unit of risk you take in your portfolio, you get a certain amount of risk premium. The more risk you take, the higher your risk premium. And that means that we could actually graph the relation between expected returns on the total portfolio and the standard deviation of the total portfolio, essentially as a function of the choice we have made between the allocation to the risky asset in terms of y and the risk-free asset of 1 minus y, essentially by just plotting different values of y, let's say from 0 to 1, and actually seeing what the expected returns at each level would be and what the levels of risk would be. We can already sort of see that this is going to be linear, right? In other words, as y goes up, our expected return on the combined portfolio is going to go up linearly by the risk premium. And as y goes up, our standard deviation of the combined portfolio is going to go up linearly by the risky portfolio's standard deviation. So now that we have actually sort of shown that this is going to be a straight line, we can also name this. We're going to call this the Capital Allocation Line, simply because it sort of describes what it actually does. For any allocation you make to the risky or risk-free asset, it can actually tell you what your risk and return profile on the combined portfolio will be. So let's put some numbers and actually go through this. Let's say that our risky portfolio has a expected return of 15%, the risk-free rate is 7%, and the standard deviation of the risky portfolio is 22%. So what sort of combinations can we actually create? What sort of capital allocation line can we actually draw? Well, once we actually plug the numbers into these functions, here is what our positions on the vertical and horizontal axes will look like. On the vertical axis, expected returns, we're going to get 7% as the risk-free rate, plus for every unit that we allocate to the risky portfolio, we're going to earn the risk premium of 8%, right? The difference between the expected return to the risky portfolio of 15% and the risk-free rate of 7%. In other words, our function is going to be a line with an intercept of 7% and a slope. Well, we're going to go up in terms of expected returns by 0.08. How much are we going to go up by in terms of risk? Well, for every unit we allocate to the risky asset, the volatility of our combined portfolio is going to increase by 22% times that weight, because that's the standard deviation of the risky portfolio. So now if we combine those, we can actually get the slope of the capital allocation line like this. Remember, the slope is rise over run. So for every unit we increase our allocation to the risky portfolio, our expected return increases by the risk premium, and our standard deviation increases by the standard deviation of the risky portfolio. So the slope is then 0.08 over the standard deviation of the risky portfolio, or 0.36. Standard deviation of the risky portfolio being 22%. And we can sort of easily think about what different points on this line might be. Obviously, if we allocate 0 to the risky asset, we're going to be here at the intercept. Our risk of the combined portfolio is going to be 0, and our expected return is going to be 7%, the risk-free rate. If we allocate 100% of our portfolio to the risky asset, then our expected return is just going to be the return on the risky portfolio, and our standard deviation is going to be the standard deviation of the risky portfolio, or 22%. And actually, we can allocate even more than 100% to the risky portfolio. Then we would get an even higher return and an even higher standard deviation. Or we could allocate somewhere in the middle, putting some of our wealth in the risky asset, let's say 50% in the risky asset, 50% in the risk-free, and that would get us a standard deviation of about, well, 50% of the risky portfolios. So in other words, if that were 22%, ours would be 11%. So we talked briefly just now about the idea that we can actually over-allocate to the risk-free, to the risky asset. Technically, I guess we could over-allocate to the risk-free asset by shorting the risky assets and putting more of our wealth into the risk-free asset than 100%. But let's focus on the idea that we actually want to allocate more than the risk, than 100% of our capital to the risky asset. How can we do that? Well, this is sort of predicated on that idea that we can actually borrow at the risk-free rate. If we can, well, that means that we can literally say we're going to borrow 50% more of our portfolio. We're going to put then 150% in the risky asset. And since we're financing 50% using the risk-free rate, that means that on the other 50%, we're going to essentially earn just the risk premium, because we will need to repay the risk-free rate of return as our cost of borrowing. And the standard deviation, of course, is just going to go linearly as before. Just now it's going to be 1.5 times the standard deviation of our risky portfolio. So really what that means is that we can extend our capital allocation line beyond 1, really as far up as we want, theoretically, or realistically as far up as whoever is providing us credit will let us do it. So while we are between 0 and 1 as the weight allocated to the risky asset, we're lending some amount at the risk-free rate. In other words, we're investing some of it. And as we go above an allocation of 1 to the risky asset, now we're actually borrowing at the risk-free rate. But always the slope of our capital allocation line is that same Sharpe ratio, because the underlying dynamic hasn't changed. For each increase in the allocation to the risky asset, we earn the risk premium, and our standard deviation of the portfolio goes up by however much we have increased our exposure to the risky portfolio, so by that fraction of its standard deviation, sigma p. By the way, why wouldn't we want to extend our line down here? Well, we would actually be earning a rate below the risk-free rate, so there wouldn't really be any good reason to do that. And we would actually be introducing risk since we'd be effectively shorting the risky assets, our payoffs could be volatile and negative. So we probably don't want to do that. So really we think about borrowing at the risk-free rate to extend our capital allocation line beyond 100% exposure to the risky asset. We never really think about shorting the risky asset to extend our allocation to the risk-free asset beyond 100%. So this is sort of why the Sharpe ratio is so important, because again, it's sort of like the price of risk. However much extra risk we want to take on, that is how much compensation we will get in terms of risk premium.